Hi, I'm Pattu from freefincal. In this video, let's talk about if this is a good time to buy gilt mutual funds. This is a question several readers have asked me over the past few days. But before we begin, I have discussed the doubling, tripling, or 80% increase of expense ratio in Tata, HDFC, and UTI index funds. And I have also answered the question, does it make sense to switch to ETFs? In today's post, the article is linked in the channel community page. Do check that out. All right, so now I have talked about gilt mutual funds recently quite a bit. This is because I've earlier shown that over the long term, an SIP in a gilt mutual fund has a reasonable chance of outperforming PPF. And of course, with all this hullabaloo about PPF rate reduction and so on, and the possibility of the rates going further down in future, there's a lot of interest in gilt mutual funds. So the first thing you should know is why is it called a gilt fund? Well, a gilt is because the government bond issued by the UK government that had a golden edge. It's a gilted edge. So that's why it's called a gilt bond. And therefore, only the government bond had it. So that's why it's called gilt bonds or gilts or sovereign bonds or whatever. Now, there are two types of gilt mutual funds as categorized by SEBI. One is called the 10-year constant maturity gilt fund. So this fund will try to keep its average portfolio duration close to 10 years. Most of its portfolio will be will have bonds which are maturing 10 years later, and it's more or less like an index fund, but it's the expense ratio will be like an active fund. The other is the normal gilt fund, and the problem with the normal gilt fund is that it's basically like a dynamic bond fund in for all practical purposes, because the fund manager will try and time the duration risk in the market. That is, the supply and demand for long-term bonds will change depending on how the market perceives about interest rates. For example, in the build-up to the RBI meeting on April 7th, the market had more or less realized that the RBI is very reluctant to change interest rates. There is increased interest rates, and it's going to keep it at the same level. So that was actually kind of priced in, and they sort of started buying long-term bonds at that time. But if the market feels that RBI is almost sure to increase interest rates in the next quarter, then they will stop buying. The demand for the existing long-term bonds will reduce dramatically, and that would mean that the NAV of the long-term gilt funds will fall. So and vice versa. So the longer the duration of the bond in the portfolio, the more will be the fluctuations of the NAV. So these funds, whether they are constant maturity gilts or normal gilt funds, they are heavily susceptible to demand supply fluctuations in the bond market. This is also called as duration risk. This is also called as interest rate risk. The interest rate risk does not happen only when the RBI is going to change or announce rates every quarter. It's a daily happening in the market, depending upon various forces: oil prices, stock markets, dollar rupee movements. Many factors will affect it. The bond market is basically as vibrant as the stock market in terms of the number of factors that affect it. So the person who is investing in these kind of funds should be aware of these kind of risk. There may not be credit risk, but there will be very heavy fluctuations of the NAV, and you should be aware of this if not used to it. So I would suggest you get used to it in a small way by starting a small SIP or investing in a small way, small amount in these funds, and get used to the fluctuations, and then you can increase the amount in it. Now, I had said that I will be investing a part of my rebalance retirement portfolio rebalance amount into ICICI Gilt Fund. I already hold ICICI Gilt Fund as part of my child's education fund. I'm fairly comfortable with gilt funds because I've been using the NPS, which is mostly gilt for me, for more than 10 years now. So I'm acutely aware of the risks. I've gone through a bond market crash with NPS, so I know how much the CAGR can fluctuate in these things. My CAGR went from 12% to 11ish% to 6% to in a couple of days. So that's the kind of huge fluctuations long-term bonds can have. And remember, the government is selling 40-year bonds, and if a fund holds 40-year bonds, then the fluctuations or the beta, as the fund manager would call it, would be very, very heavy. So you have to be aware of this. Once you are aware of this, and if you want to know whether it's the right time to buy gilt mutual funds, then I must say that if your goal is a truly long-term goal, more than 10 years away, then it does not matter local fluctuations of what's going to happen this quarter, next quarter, what's going to happen today, tomorrow in the bond market does not matter for you, and you can start buying. Same logic as equity funds. The same people asking is the right time to buy equity. What will you say? It's a long-term goal, so don't worry about what's happening today and tomorrow. Same logic will apply for gilt funds. Now, that is one argument. So you should get used to it in a small way, and you can start for long-term goals. That much is done. There's another argument. There are people who want to time the entry and exit into gilt funds. Now, I have shown a method using double moving averages that works for equity, it works for gold, it works for gilt, and that tool is available in this tactical buy and sell link. And I have discussed various methods that work for different markets and so on. And among the methods that I have discussed, one is using what is known as the bond PE. That is the 10-year bond PE is basically the reciprocal of the 10-year bond yield. 1 by 10-year bond yield is basically like a bond PE. And that's the IBEX sovereign gilt index. And you can see that the bond PE is fairly sensitive. It moves up sharply up and down, whereas the index itself is not as sensitive. So moving average of the index does not give you much of timing entry and exit data. So buy sell signals will not be available, but you can use the 10-year bond PE. I'm not, again, you must be very clear, market timing strategies are more for risk reduction rather than for return enhancement. And you can backtest all you want, but whether a particular strategy will work for you when you start investing, nobody can tell. That's the risk that you have to take. And please study the backtests I have linked in the article and understand this. Then you can gauge whether it is suitable for you or not. So one strategy I have talked about and backtested and that works reasonably well is when you buy long-term gilts when the 10-year bond PE is greater than both its 12-month moving average and 6-month moving average. So this is the 12-month moving average of the 10-year bond PE. This is the 6-month moving average. Red is the 12-month, green is the 6-month. So when the blue line, which is the 10-year bond PE, is greater than both those averages, you keep buying gilts, and when the blue line falls below both those averages, you sell the gilts and so on. So that's the kind of timing that I have talked about. And if you look at the recent data, since late 2018 onwards, the 10-year bond PE has been above both those 6-month and 12-month moving averages. So this was a good period to keep buying gilts, and only recently in the last few months, I would say December or so, maybe January, December, that's when the bond PE sharply fell down below both the averages. And because of the RBI action in the bond market and also the rates being kept constant, the 10-year bond PE started moving up. That means the yields fell down, and currently the 10-year bond PE is like above the 6-month average but below the 12-month average. So if you just go by this timing signal, and if you are interested in timing the gilts, I'm not saying you should, then currently at the very least this is an uncertain time. You'll have to wait a little bit more time to see whether the blue line moves up above both the averages or what happens. So it can be a period of uncertainties where the blue line goes up and down across those two averages and does not stay well above, which is a very clear trend for buying. So as of now, there's no clear trend for entry. Maybe at the very least you can say RBI has saved this and provided at least an uptick, but whether it will go up or not, it's not clear. You'll have to wait a bit and see. But this is only for those who want to time the entry and exit. But for those who want to do systematic investing for long-term goals only, you don't need to worry about when to buy gilts. Bye-bye.